Imagine running one of the largest technology companies in India. Tens of thousands of employees, major international clients, a company listed on the New York Stock Exchange. Investors believe you have enormous amounts of cash sitting safely in the bank. There is just one problem. Much of that money does not exist. For years, Satyam Computer Services looked like one of India's greatest technology success stories. Revenue was growing, profits looked strong, the balance sheet looked healthy. But behind those numbers was one of the largest accounting frauds India had ever seen. Thousands of invoices were fake. Revenue was inflated. Profits were exaggerated. Cash balances were fabricated. And eventually, more than $1 billion in reported financial results would be exposed as fiction. Then, on January 7, 2009, the company's founder confessed. This is the story of Satyam Computer Services, India's Enron. Chapter 1. The Rise of Satyam. Satyam Computer Services was founded in 1987 by Ramalinga Raju. The company grew during the massive expansion of India's technology outsourcing industry. Western companies increasingly hired Indian firms for software development, consulting, and technical support. Satyam became one of the major players. It operated around the world, employed tens of thousands of people, and served large international clients. To investors, Satyam looked like a classic success story. Strong growth, strong profits, a booming industry. But the financial statements were hiding a growing problem. The company's real performance was weaker than what management was reporting. So management began exaggerating the numbers. Revenue was overstated. Profit margins were overstated. Cash balances were overstated. And once the fraud began, it became harder to stop. Chapter 2. The fraud machine. Accounting fraud creates a simple problem. If you fake revenue, eventually people expect to see the cash. Satyam solved that problem by creating even more fake numbers. Thousands of false invoices were entered into the accounting system. These invoices made it appear that customers owed Satyam money for work that had supposedly been completed. That created fake revenue. But fake revenue should eventually produce cash. So Satyam also reported enormous bank balances that did not actually exist. The company even reported interest income from this fictional cash. One lie supported another. By 2008, the gap between reality and Satyam's reported results had become enormous. In one quarter, the company reported an operating margin of around 24%. According to Raju's later confession, the real operating margin was closer to 3%. That is the difference between a highly profitable company and a business barely generating meaningful operating profit. The fraud had become too large to easily hide. Chapter 3. Riding the tiger. Raju later described the fraud as being like riding a tiger. Once you're on the tiger, getting off becomes extremely dangerous. If Satyam suddenly reported its real financial results, investors would discover that the company had far less cash and profit than they believed. The stock price could collapse. The company could become vulnerable to takeover. Management could lose control. So the fraud continued. Then, in December 2008, Satyam announced a strange deal. The company planned to spend roughly $1.6 billion acquiring interests in two businesses, Maytas Properties and Maytas Infra. The problem was that both businesses were connected to Raju's family. Investors were furious. Why was a technology company suddenly spending enormous amounts of money buying infrastructure and real estate businesses connected to its chairman? The backlash was immediate. Satyam abandoned the acquisition. But the failed deal attracted even more scrutiny. And suddenly, the company was running out of places to hide. Chapter 4. The Confession. On January 7, 2009, Ramalinga Raju sent a letter to Satyam's board. In it, He admitted that the company's financial statements had been substantially falsified. Cash balances were inflated. Interest income was fake. Liabilities were understated. Revenue was overstated. Profits were overstated. The confession shocked India's business community. This was not some tiny company. Satyam was one of India's largest technology firms. It employed tens of thousands of people. It served major global corporations. It traded publicly in the United States. And now its founder was admitting that enormous portions of its financial statements were fictional. Satyam's stock collapsed. Investors lost huge amounts of money, and the scandal became one of the biggest corporate governance failures in Indian history. Chapter 5. Where were the auditors? The scandal immediately raised another question. How could this continue for years without being discovered? Satyam's external auditor was Price Waterhouse. Auditors are supposed to independently verify whether financial statements are reasonably accurate. Cash should be one of the easiest assets to verify. A company says it has money in a bank. The auditor confirms the balance with the bank. Yet Satyam was able to report enormous amounts of fictional cash. That turned the scandal into something larger than one dishonest executive. It became a failure of the entire control system. Management failed. The board failed. Internal controls failed. Auditing failed. And investors trusted financial statements that were dramatically wrong. Chapter 6. The company survives. Satyam could have completely collapsed. That would have endangered tens of thousands of jobs and disrupted major customers around the world. The Indian government stepped in. The existing board was replaced. New directors were appointed. The goal was to stabilize the company and separate the real operating business from the fraud committed by management. Because underneath the fake accounting, Satyam still had something valuable. Real employees, real customers, real technology operations. Eventually, Tech Mahindra acquired a controlling stake in the company. Satyam became Mahindra Satyam. Later, it merged into Tech Mahindra. The Satyam name disappeared, but much of the underlying business survived. Chapter 7. The lesson. The Satyam scandal contains one of the simplest lessons in corporate fraud. Profit can be manipulated. Accounting assumptions can be manipulated. Revenue can be recognized too early. Expenses can be moved around. But cash is supposed to be real. And eventually, someone should verify it. That is what makes Satyam so remarkable. The company did not simply use aggressive accounting assumptions. It created thousands of fake invoices. It reported bank balances that did not exist. And it allowed the difference between reality and the financial statements to grow until hiding it became impossible. Raju's tiger metaphor was perfect. Fraud may solve today's problem, but it creates a bigger problem tomorrow. And eventually, the tiger stops running. Satyam spent years presenting itself as one of India's great technology success stories. But when the illusion disappeared, more than $1 billion in reported financial strength disappeared with it. A global technology giant. Thousands of fake invoices. More than $1 billion in fabricated financial results. And one chairman who eventually realized there was no safe way to get off the tiger. This was Satyam Computer Services. If you enjoy corporate fraud, accounting scandals, and business collapse stories like this one, subscribe to Corporate Collapse Media and the Case Study Lab.